Institutional divergence within the Magnificent Seven has reached a critical threshold this morning, February 11, 2026. We are witnessing a definitive split between those mastering the AI capital cycle and those hitting a reality wall. The winner, Alphabet. By successfully floating a landmark $20 billion bond sale, including a historic 100-year Century bond, Alphabet has transitioned from a cyclical tech entity into a permanent global utility. The loser in today's narrative, Amazon. Despite a clean top-line beat, the market has penalized the firm with a 9% valuation haircut. The reason? Amazon's $200 billion CapEx mandate has effectively incinerated its free cash flow, which plummeted to $11.2 billion from $38.2 billion just a year ago. Alphabet is leveraging the bond market. Amazon is cannibalizing its own balance sheet. The scale of this AI bond tsunami is mathematically unprecedented. Total projected CapEx for the four largest hyperscalers, Alphabet, Amazon, Meta, and Microsoft, has spiraled to an estimated $650 billion for 2026. When factoring in Oracle and CoreWeave, the industry is looking at a $740 billion infrastructure supercycle. To put that in perspective, this build-out now accounts for roughly 1.4% of US GDP, a level of capital intensity not seen since the peak of the dot-com era. However, a dangerous monetization gap is widening. While Google Cloud and AWS report growth of 48% and 24% respectively, the immediate returns are failing to keep pace with the multi-billion-dollar deployments of custom Ironwood TPUs and NVIDIA Blackwell X architectures. Only Microsoft currently maintains a positive free cash flow margin near 22% in this high beta environment. As we look toward 2030, we must move past the software-first era. Jensen Huang's recent guidance confirms we are in a generational build-out that will require at least 7 years to reach sustainable infrastructure levels. The 100-year debt issuance by Alphabet is the ultimate signal. The cash-rich, light debt model of the last 2 decades is dead. We are entering the era of physical AI where the Mag 7 will act as sovereign-grade infrastructure providers. For investors, the play is no longer about simple earnings beats. It is about payback efficiency. Companies like Apple, with its capital-light strategy and $2.4 billion device ecosystem, are emerging as the defensive refuge for those wary of the massive debt loads required to survive this arms race. The era of the $740 billion build-out is just beginning, and the margin for execution error is at an all-time low. For daily institutional-grade analysis and real-time tracking of the Mag 7 capital rotation, hit the subscribe button for daily notifications.